Personal finance. Understanding credit card and debt management and your debt and credit card is essential for the personal aspects of your finance. Having enough money to pay off the balance on time can help you improve your credit score. If you are not able to pay the balance on time, interest occurs and the amount you owe will be larger. Using credit wisely to avoid borrowing from one creditor to pay off another is important. So these are going to be tips that you should keep in mind to help you with some of these decisions. Pay on time. Penalty is something that you don't want to get. And you can get this every month if you don't pay on time. So please pay on time so that you can avoid credit card debt and penalty. Always find out what your agreements are and be very careful so that you can avoid penalty. After reading the fine print, pay your monthly statements. As soon as possible, it can be helpful for you to organize yourself by setting reminders for your payments. You can also try to pay your debt as soon as possible for the means of keeping an eye on where your money's going. Often cardholders incur too much debt. With this, they begin to utilize certain amounts of interest that really didn't have to be there. However, by paying off your balance halfway through or midway through the billing cycle, you can have an average advantage over the debt. If you only use a quarter of your credit card per se, you're actually holding off on interest for 3/4 of the balance. So keep that in mind. The pay on time penalty for credit cards and debt varies. Generally, late payments result in late fee and it will add up to significant percentages of your balance. Some ledgers don't report late payments up to 60 days past due. Regardless of how you choose to handle your payment, it will affect your credit score. Depending on how much you've missed in the past, late payments will hurt your score. Pay on time. Paying credit cards and debt is vital if you want to keep your credit score high. If you fall behind on payments for more than 30 days, your credit card issuer is likely to be charged with a late fee and increase your interest rate. If you're not able to pay your bills on time, your account will be closed and you will be responsible for paying your debt. You can opt into auto pay and notify insurance companies before you fall behind. Interest occurs on old balance, and this is important because many credit cards charge interest based off of old balances every day. The interest rate is calculated by daily multiplying your balance each day by a certain percentage. This daily interest rate is often called compounding. It's possible to avoid paying interest on purchases while using credit cards that have a grace period. Credit card companies also calculate interest on purchases based on the balance you owe to your account. If you have an outstanding balance, credit cards can be important to pay down as soon as possible. Most credit card issuers use a daily average balance method to calculate the interest charge, meaning that each day you don't have to pay additional interest charges and they will accumulate based off the balance in a whole. Ultimately, paying off your balance in full, though, will result in less interest over the month and in the long run. But you should still pay your balance in full every month to avoid occurring financial charges. If you use your credit card without paying a full amount, the interest will continue to accumulate, and on unpaid balances, your credit card companies will calculate interest daily or monthly. This means that if you leave a $100 balance on your card, it will accumulate another $1,700. This is insanely big, but realistic in interest. You can eventually end up saving by paying more than you originally intended to, avoiding that issue by paying your balance down when it's much lower. So that is something that you're going to want to keep in mind when it comes to that. The higher the interest rates, the more you'll have to pay off your balance. When you use a credit card without a grace period, interest occurs on balances daily instead of monthly. The interest rate on a credit card is calculated by the average daily balance, which means you need to check your statement and see which days are included in the billing period. So you check for interest rates and how to calculate it on new purchases. It's important to note that there are different APRs for each balance category. The Consumer Financial Protection Bureau defines interest on credit cards as the price you pay for borrowing money. This extra charge on revolving debt makes it more expensive. Whether you're trying to buy a new car or luxury item, high interest will raise your payments. You should always pay off your balance in full each month if you can. Follow these tips so you can avoid pitfalls of credit card debt and stay away from financial disaster. Using credit wisely. Now, this improves your credit score while you may not be able to pay more than you have to, using credit wisely essentially is good for maintaining a good credit card and being able to pay that down with a chance to improve your credit score. So when you're trying to improve your credit score, using your credit card for things like entertainment and meals, things that you planned on paying with cash anyway, can be very beneficial. Many people don't understand the impact of credit usage, and many do not learn the importance of managing their credit wisely. So if you can do this, this would be important. Having a credit card can be a helpful tool in making purchases that are major decisions, but it's important to know how to use them responsibly. Credit cards are very convenient and can build up debt with them. In addition, many of them offer rewards, which is a good option for building credit. So use your card wisely to keep it from getting out of control. However, remember that credit wisely will improve your credit score. Using credit improves your credit score by limiting the amount of interest per day. Using the credit score model when you're utilizing your credit is going to help you pay down and keep track of things such as your rewards. You might also want to get a credit card similar to the features of cards like Chase so that you can pull your Chase Ultimate Rewards. This will give you more options when redeeming your rewards. Paying your bills on time is another way to increase your credit score. By paying off your balances on time, you can avoid incurring interest charges. Even if you can't afford to pay the entire balance on time, paying at least a minimum amount is beneficial. Using a credit card will wisely boost your score significantly. So following these tips, you can establish a strong credit history and start enjoying your money's worth. Personal finance savings for retirement. As you save for retirement, you may want to consider a tax-advantaged retirement plan. If your employer matches your contribution, you can count these towards your savings goal. You should also have a small emergency fund, ranging from 3 to 9 months of living expenses. If you can't save enough money, you can always borrow from family and friends. In addition, you should consider life insurance or real estate as a retirement asset. Tax advantage retirement accounts, the solo 401k plan offers the benefit of being easier to administer. Also allows you to have a higher contribution, but unlike simple IRAs, a solo 401k requires creation of a standard 401k plan, which is required for small businesses to hire employees. You may want to choose a different type of account if you are limited on budget, or you may prefer the flexibility of a Roth IRA. In order to maximize the benefits of a tax-advantaged retirement account, you must understand the advantages and disadvantages. These accounts offer many benefits, and a tax-advantaged investment might be right for you. High-income taxpayers, for example, can invest in municipal bonds to get income that is tax-free. Employees can also save for retirement with an individual retirement account or IRA. The primary benefit of these accounts is the tax deduction, which is a nature of investments earning. They are tax favored and will save you a substantial amount of money over the long term. To maximize the tax benefits of tax advantage investments, you should invest only what you can afford. Consider seeking advice of a financial expert or tax advantage associate, some sort of advisor. Once you've chosen an account, make sure to carefully analyze your earnings each year. A Roth IRA. Now, this is an investment that offers an account that lets you return for a higher contribution, more limits than the regular IRA. A Roth IRA is easier to maintain and is accessible. The funds that you receive are subject to your investment decision, so it's important to resist temptations to withdraw money too early. Otherwise, you likely have to pay a 10% penalty. There are many other types of tax-advantaged retirement accounts available to small business owners and self-employed individuals. There are many advantages of setting up a SEP IRA. It's like a traditional IRA, but it's set up for a small business. So these things, such as SEP IRAs, can be pretty helpful for you. You want to understand that it's good for owners and also can be utilized with employees. The pre-tax contributions are higher, so the self-employment worker can contribute 25% of their self-employed income, or $58,000 as of 2021. A self-employed individual can open a SEP IRA through a broker or investment company. The only downside is there is no Roth option for a SEP IRA, but it's theoretically possible to contribute to a Roth IRA. Investing in a tax advantage plan, while tax considerations are important, they shouldn't drive your investment's early choices. Early withdrawals from retirement accounts may incur 10% federal income tax penalty. The same holds true for other tax breaks offered by the state, such as scholarships and financial aid. When it comes to retirement investments, you should choose those that are maximized tax deferred accounts to reduce your chances of taxes in retirement. In addition, by holding appreciated investments for longer periods of time, you can take advantage of long-term capital gains tax rate, which range from 0 to 20% depending on your income. There are two main types of IRA for self-employed individuals, a traditional IRA and a Roth IRA. While a traditional IRA allows for a contribution, a solo IRA is much easier to set up and terminate. However, solo IRAs have limited Roth options and require that the owner file a Form 5500 SE annual to report their investments. IRAs and 401k plans are two popular types of tax advantaged accounts. Traditional IRAs and 401ks are examples of tax deferred accounts. These accounts can provide tax benefits to investors, which can save thousands of dollars over the course of a lifetime. You can also invest in municipal bonds and high yield bonds for additional tax deferred protection. While the first type is a freebie, the second type is a better option. Roth IRAs allow for higher contributions and are easier to manage, making them more attractive options for many people. These investment plans provide tax-deferred growth and protection for a lifetime. You should not make a premature withdrawal if possible, though this will result in a 10% penalty if you do. However, it is worth considering both types of IRAs to determine the best one for your needs. The best investment accounts offer the best tax-deferred options, while mutual funds and exchanged funds that are on exchange are popular options for retirement savings. Tax advantage accounts offer greater tax efficiency. These types of accounts are often great for short-term goals such as education, healthcare, or childcare expenses. In short, you can save a lot of money when you choose the right combination of investment vehicles. Real estate as a retirement asset. If you're focusing on personal finance savings for retirement, consider real estate as your investment choice. Investing in real estate can give you a substantial income as a property's value will grow over time. If you're interested in generating an income in retirement, consider investing in rental property. While the amount involved in renting out a property is small, it can add up over time and provide additional sources of income. Real estate is a perfect asset for retirement. It's great for a portfolio. It's the best option for a high net worth individuals, a chance to reduce risk associated with market downturn. The other advantage of real estate is that it provides a stable and consistent income stream, which makes it a great diversifier of other investments. Real estate is typically less volatile than conventional assets and can be a good hedge against inflation. It also offers a high degree of tax benefits, which makes it a great choice for people who wish to diversify their portfolio. Although a down payment is typically required for a rental property, it may be too high for many people. Some areas are simply too expensive to buy property, so it's a better option to invest in real estate investments, trust, REITs, exchange traded REITs. These are all good options for people who want to invest in real estate but aren't yet ready to make a down payment on a house. In the rising housing market, you can purchase multiple types of properties. You can sell one of them, rent one later. The additional income is generated from property and can be used to fund your retirement. The gains for selling a home, your home, are tax-free and up to $500,000. And there are also potential to earn higher than that of a rental. This could be a great retirement asset for anyone. So real estate is an excellent choice for diversifying personal financial savings for retirement. It can help you save for retirement while allowing you to earn income for the rest of your life. In addition to earning a stream of passive income, real estate also provides an excellent investment vehicle. You can collect rental and monthly income while you're hands-free and choose to hire a property manager. In addition to generating potential real estate income, it's also appreciated and comparable to other retirement assets. So real estate is a great option to borrow against. Life insurance is a retirement asset. While the benefits of whole life insurance may not be immediately apparent, they can play a key role in your retirement plan. Permanent insurance, such as whole life insurance, guarantees the cash value will never go down. This can help you avoid selling market-based investments during market down overturns. Since cash value in a whole life policies do not fluctuate, however, you can take cash value from your policy, permanently reduce the death benefit. Likewise, borrowing against a policy may temporarily lower its cash value. A universal life policy provides that with your income in retirement, the cash value in this policy accumulates tax-free. The cash value can be used to help retirees supplement Social Security benefits. This may be a useful cash bridge between retirement age and Social Security benefits to start kick in. Others choose to leave the policy until it matures, cashing out later when they can get the maximum benefit. Longer lifespans and early retirements make it possible to extend retirement periods. However, rising health cost cares are a factor to consider. One of the biggest financial concerns of Americans during retirement is running out of money. This is not uncommon, and it's a popular fear. By acquiring life insurance through a policy, you can build a nest egg that will last you for decades. So if you purchase the right policy, you can enjoy the benefits of tax-deferred accumulation and regular income. Despite its low profile, life insurance is a good investment for your retirement. The cash value in your policy can be borrowed without paying taxes. It will accrue interest and be subtracted from your death benefit. The cash value in your permanent life insurance policy can also be used to pay premiums that will increase in the future. If you choose to take out a loan, get your cash value in your policy, make sure you understand the repayment terms of your loan and the consequences of taking out a loan. So I hope this video has been helpful. This has been a great breakdown on ways that you can invest and look for retirement. Please like, subscribe, and hit the notification bell. And thanks for watching the video.